Welcome back to another edition of Boss Economic World, the only show where we turn economic potholes into a high-speed autobahn of laughs. Today, we're taking a deep dive into the latest economic slapstick aired by the global central banks and government misadventures. Grab your calculators, because we're about to break down a saga that mixes glacial inflation progress, relics of fiscal policies past, and the persistent guardrails of monetary mismanagement, all with a dash of irreverence and plenty of economic insight. Let's start with the elephant in the monetary room, inflation. The Federal Reserve's preferred measure, the Core Personal Consumption Expenditures, PCE, price index, has finally eased to a pace that, while steady, is arguably the slowest since June. It's like watching paint dry, but in this case, it's drying at 2.6% year-on-year from January's data. The devil, of course, is in the details. While volatile items like food and energy have been trimmed from the metric, the remaining components keep nudging the overall index above the Fed's precious 2% target. Now, if you think this is a minor miscalculation, think again. This stubborn number is a stern indicator that inflation, despite its gradual deceleration, is refusing to play ball. The Fed's cautious officials are well aware that the so-called cooling is coming from categories that were relatively tame in wholesale data, whilst CPI components continue to pack a punch. Imagine heating a soup on low heat. Sure, it's not boiling over, but it's far from reaching that perfect simmer you'd want for a tender bite. This is why Federal Reserve policymakers prefer to keep rates on hold for now, because lowering interest rates without clear signs of sustainable disinflation would be like throwing gasoline on a smoldering campfire. In the midst of this inflationary saga, we have a parade of central bank officials readying their exit speeches and new policy teasers. Michael Barr, the soon-to-be ex-vice chair for supervision at the Fed, along with his colleagues such as Richmond Fed President Tom Barkin and Cleveland's Beth Hammack, are all scheduled to offer sound bites that sound more like economic riddles than clear signals. Their frequent public appearances remind us that even when economic data looks somewhat promising, the Fed's message is as cryptic as the plot of the latest binge-worthy crime drama. This evolution in leadership might be our saving grace, if only the new faces bring clearer strategies to tether runaway inflation. Instead, what we've seen historically is a disconcerting mix of lip service and cautious optimism, as officials figure out together whether to embrace policy shifts or continue treading water. And in a world where policy missteps can send shockwaves across global markets, the entire show often feels like juggling flaming torches blindfolded. Shifting the spotlight to international trade dynamics, the Commerce Department is about to reveal that our trade balance reached record proportions in December. While President Trump might have relished this news in his second term, the underlying message is clear: our trade battles are far from over. A trade deficit is not merely a number, it's a manifestation of decades of complacency in policymaking. It's the economic equivalent of ignoring a leaky roof until your basement starts swimming. Across the border, Canada's fourth-quarter GDP is expected to show signs of a robust recovery fueled by aggressive rate cuts. But beware, the positive momentum might falter as the looming trade war casts its long, dark shadow across business investments. It's like watching a sprinter who, after a promising start, encounters a never-ending series of hurdles just when victory seems within reach. Meanwhile, in the old-world drama of Germany, investors now eagerly await the aftermath of the snap election. The pro-business CDU/CSU bloc, led by the ever-dapper Friedrich Merz, is touted to secure the largest vote share. However, their victory largely depends on transforming fickle voter optimism into solid fiscal strategy. The snap election also kicks off debates about Germany's infamous debt brake, a fiscal tool that has become as controversial as that old family recipe everyone pretends to love but secretly abhors. Bundesbank President Joachim Nagel is expected to weigh in, likely criticizing the persistent reliance on neoliberal orthodoxy that has, time and again, cornered the economy into one-way streets with no exits. Zooming in on Asia, we encounter a veritable montage of central bank decisions reminiscent of a global reality TV show. The Bank of Korea is under the microscope as market pundits speculate whether it will jumpstart the rate cut cycle to mitigate dampened export demand amid escalating tariff fears. Governor Ri Chang-yong's earlier remarks that a rate cut wasn't a done deal have only fed the uncertainty beast, a term that, in economic jargon, means prepare for more hair-raising twists in this narrative. Simultaneously, the Bank of Thailand and the Reserve Bank of Australia find themselves in a dance of cautious optimism. In Australia, fresh rate cuts mark the end of a long hiatus since 2020, yet consumer inflation shows a worrisome tendency to accelerate. If Australia's inflation were a Hollywood movie, it would be a sequel that, despite its promise, simply can't seem to escape the haunted ghost of its predecessor's financial misadventures. Across the Pacific, Japan and Singapore are also juggling their inflation data. Tokyo's CPI may reveal sustained elevated price levels, while Singapore's core inflation looks likely to moderate. This regional dissonance in inflation dynamics only reinforces the idea that despite similar economic principles, local idiosyncrasies, and sometimes a bit of governmental inertia, cause divergent outcomes on the global stage. No global economic tour is complete without a jaunt through Latin America, where the numbers often read like a telenovela script. In Mexico, we're expecting a bit of a whiplash moment this month. With early forecasts predicting a 30 basis point jump in consumer prices, we're left wondering if the central bank's inflation tolerance is as flexible as the contortionists at a circus. However, the core print remains relatively steady within the official comfort zone of 2% to 4%, a narrow window that might as well be a golden cage for economic policymaking. Chile, on the other hand, is slated for a robust data dump covering everything from industrial production to retail sales. The numbers are expected to echo the success of its late 2024 finish, yet the underlying tension remains: will economic growth be sustainable or a mere mirage in an arid desert of fiscal reforms? Argentina, having recently clawed its way out of a recession with 2 months of unexpectedly good growth, now faces the monumental task of sustaining that momentum. In a country where economic policy is often a blend of populist rhetoric and fiscal fancy, the challenges ahead are as formidable as they are unpredictable. Brazil, Latin America's economic heavyweight, is finally showing signs that it might be cooling off after a period of frenetic growth. Yet, consumer prices, which soared to a cap of 4.5%, the unofficial limit of tolerated inflation, are expected to drop gradually, much like a boomerang thrown by an indecisive policymaker. National unemployment figures, on the other hand, might suggest that while the labor market is easing, the long-term structural issues remain stubbornly entrenched, akin to a bad habit you just can't shake off. Over in Europe, the plot thickens further. The continent is waiting with bated breath for monthly inflation data from its 4 economic giants: Germany, France, Spain, and Italy. Predictions range from slowing inflation in the powerhouse economies of Germany and France to an uptick in Italy, which sounds like a recipe for chaotic economic symphony rather than a harmonious market chorus. The United Kingdom is not immune to this fiscal farce either. With multiple speeches lined up by Bank of England policymakers, including Deputy Governors Claire Lombardelli and Dave Ramsden, the stage is set for a grand debate on the future of interest rates. The talk is not just about whether to change rates, it's about navigating a labyrinth of post-Brexit uncertainties, domestic political intrigues, and the ever-lurking specter of economic stagnation. In a similar vein, smaller economies like Sweden, the Czech Republic, and Iceland will release their quarterly GDP numbers, each offering a unique case study in how local policies can either amplify or mitigate global economic trends. These data points, though numerically modest, are crucial reminders that even the smallest economies serve as the canary in the coal mine when it comes to predicting broader shifts in global monetary policy. Turning our gaze to Africa, South Africa's recent inflation reading, jumping from 3% to 3.2% in January, marks a significant turning point. This slight uptick, though seemingly negligible, comes in the wake of a consumer price index overhaul. It is a stark reminder of how data revisions and statistical rechecks can dramatically alter the economic narrative, sometimes making the best-laid plans of policymakers look like scribbles on a napkin. Simultaneously, South Africa is set to host the first group of 20 finance minister central bankers summit since Trump's return to office, a summit that feels like a reunion tour of economic disarray. With Treasury Secretary Scott Bessent opting out due to contentious spat-worthy issues, including domestic land laws and stances on international conflicts, the summit promises to be as contentious as it is critical. It's a classic example of how political squabbles can derail even the most meticulously crafted fiscal strategies. Further east, Israel's central bank is poised to hold its base rate steady at 4.5% for the 9th consecutive meeting. Governor Amir Yaron, juggling domestic economic pressures, like inflation still ticking at 3.8% despite geopolitical tensions, has made it clear that any talk of easing will be reserved until the second half of the year. The delicate balance between achieving a ceasefire-induced economic reprieve in conflict zones and meeting domestic inflation targets is one tightrope act that even the most seasoned policymakers might envy. Hungary, too, is playing the waiting game. With its central bank expected to keep interest rates unchanged for the 5th month in succession, outgoing officials have frankly stated that there's no room for rate cuts in 2024. It's a raw admission that in an era where policy miscalculations can lead to runaway borrowing, sometimes prudence is the only acceptable headline. So, what's the grand takeaway from this global economic comic? In a nutshell, persistent inflation pressures, tepid growth signals, and an overabundance of bureaucratic dithering have conspired to leave markets and consumers alike feeling like extras in a tragicomic play. The Federal Reserve's hesitance to lower interest rates, despite the slow progress on cooling inflation, reflects a deeper malaise in modern economic management. Policymakers are essentially stuck in a perpetual wait-and-see mode, balancing the risk of an economic downturn against the potential pitfalls of premature stimulation. This cautious stance is reminiscent of past economic debacles. Think of it as a historical replay where every central bank is forced to rewatch the highlights of the Great Recession while desperately trying to avoid another rerun. The core principle here is clear: when inflation remains persistently above target levels, even marginal improvements are not enough to justify aggressive policy shifts. It's a bit like trying to fix a leaky boat with duct tape. It might slow down the water, but it won't stop the sinking ship unless you address the whole structural issues. The danger here is that mixed signals from central banks can ultimately lead to a loss of investor confidence. Markets are acutely sensitive to uncertainty, and every ambiguous comment, every half-committed policy move, adds another degree of risk premium to an already volatile economic landscape. When government officials choose rhetoric over decisive action, they inadvertently fester the very conditions that hinder sustainable growth. What makes our current analysis both timely and hyper-relevant is the robust body of recent data. From the integral components of the PCE index, at 2.6%, not bad, but not good enough, to the real-time trade imbalances and consumer price reports across continents, every data point reinforces the narrative that central banks are caught in a policy limbo. Add to that the scheduled speeches, upcoming GDP readings, and labor market reports from both developed and emerging markets, and you have a veritable data festival that's a mixed bag of hope and trepidation. For instance, the record widening of the goods trade balance in December reveals underlying structural issues in our trade policies, an issue that, if left unchecked, could spiral into prolonged periods of stagnation. Similarly, forecasts from the Reserve Bank of Australia hint at consumer inflation acceleration, a red flag that economists cannot afford to overlook. Even in regions like Southeast Asia and the Middle East, where geopolitical factors add another layer of complexity, the persistent theme is one of cautious maneuvering rather than decisive action. And let's not forget Latin America, where nations like Mexico, Chile, and Brazil are each dancing to the beat of their own economic drums. While one country may exhibit signs of recovery or growth, another might plunge back into recessionary concerns, all against the backdrop of a global narrative that's increasingly defined by uncertainty rather than confidence. At its core, the current economic scenario is less about random market fluctuations and more about a deep-rooted issue in government economic management. The persistent reliance on outdated policy frameworks, cooked up during eras of much lower global complexity, is straining under the weight of modern economic challenges. When policies that were once effective become the very chains that hold back potential growth, it calls for nothing short of a hard reset. It's high time policymakers took the kind of bold steps that recalibrate the economic engine, steps that may involve uncomfortable fiscal adjustments, structural reforms, and a willingness to challenge the status quo. Instead of merely patching up the symptoms of inflation and trade imbalances, they must address the underlying causes, long-standing regulatory inefficiencies, misaligned incentives, and the ever-pervasive influence of short-term electoral gains over long-term economic welfare. As we watch central bankers shuffle their decks, delivering speeches that are as elusive as cryptic crossword puzzles, we must remind ourselves that the true test of any economic strategy lies not in its theoretical elegance but in its ability to produce tangible, sustainable prosperity. And if current trends are any indication, we may be on the brink of handing over the baton to a future generation of policymakers who are not only wiser from past mistakes, but bold enough to disrupt the business-as-usual narrative. Ladies and gentlemen, as we wrap up today's commentary, it's worth remembering that while the headlines may look grim, the glacial pace of inflation cooling, the contradictory signals from international data releases, and the incessant governmental dithering, all these factors together paint a picture of an economy in need of fundamental rethinking. The message is clear: when the policies designed to guide us into calm waters end up driving us in circles, we must not be afraid to disrupt the narrative and demand real change. Here at Boss Economic World, we believe that laughter is the best antidote to despair, but informed laughter. It's a call for both policymakers and the public to critically examine economic strategies that seem more suited to a bygone era than a modern, interconnected global economy. So, fasten your seatbelts, sharpen those pencils, and prepare for what promises to be one wild ride into the next chapter of economic misadventure, and hopefully, eventual reform. Thank you for tuning into this spirited exploration of the tangled web of global economic policy. Remember, in the world of economics, as in life, it's the bold, critically minded thinkers who create lasting change. Until next time, keep questioning, keep laughing, and as always, stay economically savvy.